called on Friday. So how are capital markets relevant to business owners now that we are grappling with these strains of this COVID-19 lockdown?
Well, what you can see is when we look at financing, business owners have been going to the banks. And while the banks offer a short-term financing, which is helpful to the businesses, you find that in such a times, like when business is low, you still have to pay back your loan. You see, the banks can only do so much as give you a holiday for so long, but they need their money back. And when we look at other forms like private equity and the long-term debt financing in the private markets, you look at some of these private equity firms have actually put in more money in terms of debt and private equity into these firms that they're invested in that were struggling to take them through this COVID period. Because these are investors with a long-term view, you know, of the economy. So they're able to say, okay, we know that this COVID-19 environment will end, you know, once people get vaccinated. So since we're here for the long term, we're able to put in more, you know, capital into the businesses to see them through that. And then also, we also have, which we'll touch on a bit, the Capital Markets Authority has also partnered up with FSD Uganda to with a deal flow facility, which is going to, in addition to providing advisory for the business owners, it's also going to be a source of capital for the business owners up to at least $500,000 for each company. So there are various ways in which you can be supported during this COVID time.
All right. Thank you very much, Susan Kaiser. She is the founder of Can Consultancy. Let's also bring in Alan Lwetabe. He is the head of reserves management at the Central Bank, Bank of Uganda. Alan, let's talk about another partnered issue in 2017-2018. Well, we do know that private equity, and at the same time, our Ugandan counterparts were registering some 150 of private equity investment within our region.
All right. 1.2 billion is almost the amount of money we receive from remittances annually over the last 5 years. And we would like to see that money being available in firms within the private markets.
Also, what we do know about private equity, it involves funds and investors who actually directly invest in private companies. Yes, they directly invest in private companies, and they also engage in buying out public companies which get delisted. So we are talking about investing in private companies, not public companies at all. Let's also bring in David Ives. Please break down for us what private equity actually means.
So thank you, Romeo. Thank you for having us here. Going back to the cue that the other presenters have made about private equity being a long-term source of capital, a patient source of capital, and a flexible source of capital, there has been great and tremendous growth in this sector in terms of the advantages it presents for enterprise. The bedrock of Uganda's business ecosystem is largely small, medium-scale, family-owned businesses. And private equity represents the best partnership in terms of developing family businesses into structured, well and seasoned businesses ready for financing at the next stage. In addition to that, private equity has helped to pool talent into the business ecosystem of the small and medium scale enterprise by hiring trained professionals to come and manage these enterprises. That represents, the partnership level of development. The fact that it is long-term, it certainly then supports businesses take risk and make mistakes, in the early days of formation, while the growth aspects are being addressed by developing a management team and realizing the core business model, which is something that traditional forms of capital are not ready to provide in terms of allowing risk, allowing restructuring, and allowing capital structures that are flexible to the cash flow risk of the inherent underlying businesses that are being run. So those are the specific advantages that private equity offers in terms of being a long-term and patient channel for capital, in terms of being a flexible source of capital, developing alongside the enterprise risk levels, and also in terms of being a source of pulling talent together, not only at the operational level, but also at the board level.
We also do know, Ivan, part of the challenges of private equity, it is hard to liquidate holdings because they are not public.
The challenge, one of the biggest challenges of private equity in Uganda and development of the private equity asset class as a route to investment is largely around exit. Now, exit is addressed through many different scenarios. So private capital, in a sense, can be channeled in form of direct equity investment or even debt investment or quasi-equity investments. But these are not the terms that certainly the audience wants to spend time on. The structuring really is to enable, give the entrepreneur a chance to visualize how best to exit the investor over a period of time. And the fact that it has a long-term view, and when I say long-term view, usually private equity or private capital market structures of investment take 5 to 10 year views. That view then enables the different parties to come together and determine exit over the life of the investment. So without saying that exit is a guaranteed route or exit is guaranteed, what we would like to be able to emphasize is that there is sufficient room to debate or determine which strategic partners to bring on board, what is the business course going forward, realizing that business value, and then identifying the partners that can take the business to the next stage.
David, what are these?
We've worked with, at Pearl Capital Partners, we've invested over the last 15 years in the markets of Uganda and East Africa and the region at large, and worked with a couple of enterprises over that period of time. We invest largely in the agribusiness value chain, and that represents a legacy record of success in deployment of capital and realizing exits. Some of the investments that we've made largely have been taken on by strategic partners, that is, partners who are looking for an entry into Uganda, but do not have a foothold of a business that has been created and grown by private equity. One such example that Pearl Capital Partners has worked with over the long period of time is Biinzika Poultry International Limited, that was eventually assumed by the investment was eventually assumed by bigger private equity players from the UK and strategic partners who would like to take a part in that business. So that's one example of an enterprise that we've gotten from a very nascent stage, family business, trading on the dining table, and now it's in the boardrooms of Uganda, playing a major role in employment and enhancing the value chain of poultry in Uganda. So that's just one clear example of what private equity can do in terms of transformation and in terms of determining exit. So whilst the exit was not necessarily in the public market through a public listing, it was managed through a strategic partnership of financiers and people interested in the poultry value chain in Uganda.
David, we would also like to know what are the prospects of private equity right here in Uganda, being that alternative source of capital as compared to traditional means of raising capital. We do know that many of our people do not have national IDs. If you do not have a national ID, a bank won't give you money because they need to first verify who you are. And it's largely different with private equity. But then what are the chances of PE actually graduating and being that one alternative source of raising capital?
So being Uganda, as we understand our business ecosystem, the challenge has been identification of business address, identification of partners or players or management in those business, and really identification of the market where those businesses operate. Certainly banks are not designed or shaped to evaluate these business risks, and largely banks will want to trade or do business with proven and sure business opportunities. So private equity certainly plays what we can call the smoothing role or the road to bankability in terms of getting businesses better identified. By identification, I mean having books of accounts, compliance with the regulatory authority, formation of boards, determining business strategies, and having a coherent strategy. And once those businesses can trade successfully under the private equity long-term patient capital value proposition, then they can slowly graduate into the traditional forms of financing, such as commercial banking as we see it or structured today, not the other way around. So we feel that private equity certainly does plug into that space and enable small and medium-scale enterprises, even without the core identification factors as business should be, still also play a part in their development of Uganda and employment of its citizens.
David Ivan Wangolo, he is an investment manager with Pal Capital Partners. Thank you very much for availing us with that insight. Let me also bring in the founder of Kayan Consultancy and a board member of the CFA, Society of East Africa. That's none other than Ms. Susan Kaiser. Let's talk about the collaboration between the Capital Markets Authority, the European Union, and also the FSD Uganda. Talking about the deal, the DFF, the deal flow facility, that is adjourning to close over 40 deals, each about $500,000. Wow, that is huge. So how relevant is this DFF, the deal flow facility, to our people here in Uganda, the firms and the innovators? How relevant is it?
I think, okay, this collaboration is going to take place over the next 5 years. I think the first thing of relevance is it's actually offering capital. The $500,000 for each firm, that's roughly 1.7 billion Uganda shilling.
That's huge.
Yes, that is huge. And what it doesn't just come, it comes with also training, capacity building of these firms in readiness to take on this capital. And this capital is patient capital. It's willing to go in for the long run. They're not looking for quick returns. And also when it comes to capacity building, you see the reason why Uganda is unable to absorb capital is a lack of capacity. Because the farms are small and they're being run, you know, at the dining room table, and they're not interesting to investors. So when you come and build these firms up to a level where they can absorb larger amounts of capital, you know, they're able to create more products and services, they're able to employ more people, and so some of the things which maybe we're importing, we shall be able to produce locally, and on top of that, we're creating more jobs, and that increases the savings, which goes back into the banks, which goes back to increased borrowing. So it is a full run effect on the economy.
All right, what do the firms need to do right now to prepare themselves to tap into this money?
I think what you have to do is you have to have proper books of accounts. You have to be in line with the regulators, for example, the tax authorities and everything like that. You have to have like a plan of growth so that someone, when they're looking at the company, they're saying, okay, I'm in this company today, I probably want to exit in the next 5 or 10 years. So they want to see a plan of growth, like a strategy of how you plan to run your business. So you need to have your books in order and a good governance structure, such that someone who is putting in their money knows that, you know, their money is not going to be swindled, because there's no use of proper books of accounts, be in line with the regulators and the authorities. Yeah.
Alan, wait a minute. Let's talk about another issue, pension schemes in Uganda. Participation of local pension schemes in the PE industry has been very low. That's what we've noted as NMG. And we would like to know what could be the challenges stopping pension schemes from actually taking on private equity.
Yeah, Romeo, you raise a very pertinent question that is influencing a lot of policymakers and regulators. We know that UBRA, the Uganda Retirement Benefit Regulatory Authority, permits pension schemes to place up to 5 to 10% of their assets in private equity. They are permitted. But what we have seen is that NSSF has been a pioneer in that space. They have participated with Pearl Capital in the Yield Fund, which was established a few years ago. They were the pioneer, but we have not seen other pension schemes move in that direction. If you look at the top 10 pension schemes, they have about almost 2 trillion shillings in assets, and the regulator permits them to invest at least 5% or 10%. That's about 200 billion. 50 to 200 billion is available, potentially on paper, to be channeled into private markets. And we are seeing that if this money is channeled, it can have a big impact on local businesses. A lot of the funds that we see in the private equity space are foreign owned. It is money coming from other countries being brought here to influence businesses in Uganda. What we'd like to see change is Ugandan money influencing Ugandan. By this building the local capacity through building local businesses and but also allowing the economy to grow faster. So it's a very invited to think about adjusting this. But what are their challenges? What we see is that a lot of schemes you've correctly highlighted is the illiquidity. Especially in the COVID environment. And so a lot of pension schemes are afraid to take this step. And so one of the things that we are seeking to do as CFA Society East Africa is to bring investor education, but also to bring our expertise that allow us to minimize the risks, the investment risks that the pension schemes face, and allowing them to be able to do these investments, being clear in our guidance on what are the available exit mechanisms.
Indeed.
And so that's some of the stuff we are working with, and we are working with the regulators to put this in place. We believe in the next 5 years, we will have a transformation and see more local money coming into the private equity space.
They're also talking about the pricing of the shares. The pricing of the shares for a company in private equity is determined by through negotiations by the buyers and the sellers. There's not by the market forces. Isn't this a disadvantage?
It's not a disadvantage. It's actually a very appropriate way to look at things because you have professional investment entity generate money enough to of fundamentals of the business. And so it's the professional investor that is able to unpack and understand what is happening, what's happening in NMG, what's happening in MTN, how do they generate cash flow. The professional investor, it becomes a lot easier price for exchange of shares. And so it's not a disadvantage. It's actually one of the most powerful tools that private equity brings or a private investor brings. Of course, in private equity, one of the biggest advantages over public markets is that a private investor brings knowledge, expertise, is able to add consultations. They provide consultative services to improve the business as a whole and allow the business to grow. And that leads to growth and, of course, expansion and development. So it's important to understand that it's not only capital, physical, financial capital that is brought on board, but also technical expertise and, of course, human capital that can be brought together to improve a firm's performance.
All right, David, Ivan Wangolo, please, if you can still hear me, please break down for us the popular types of private equity that we are dealing with right now. The private equity funding, including distressed funding and so forth.
Largely, private equity is a cycle of deployment of capital. So at what stage is the capital being deployed is what defines the particular structure. All businesses start at an idea, and usually the idea stage, or what we are calling the initial stage of investment is the first stage of private equity investment. And in this stage, usually we rely on our friends, family, and ourselves to kind of push the idea forward. Beyond the idea stage, and when we start getting into the commercialization of the idea, proof of concept stages, then private equity takes a different really people are prospecting on the likelihood of the idea going beyond the ideal concept stage into full-blown commercialization. And once an idea has been fully conceptualized and has started to commercialize, then or the growth stage. But usually the capital that is provided now after the venture stage is early stage, when business systems have been set in place and the concept is now clear, the market opportunity is clear, the business model and how it makes money is more clarified, there's more route to evaluation, so to speak. When idea gets into venture and then early stage. Then once it moves from early stage and it's now really an idea that can be sold to other players, then private equity takes a definition of growth capital, which is where a lot of businesses are in Uganda, beyond the idea and proof of market or venture early stage. So now the growth stage is really the critical mass that market and be sold to other people. And that's where players or main private equity players really play in this market at the growth stage, or providing growth capital, which is more long-term and ring-fenced around systems, ring-fenced around structures, ring-fenced around teams, boards, certain products and services, and niche markets where they grow.
Are we talking
and
about
that growth stage
financing
capital
then?
that is quite critical to determine that you can have a bedrock of sustainable business. Because beyond growth, then we are going to consolidation stage, where we take out the smaller players, or the smaller players come together, as we've seen in different sectors. And as they consolidate, then they might come into the public market as a listing. So that's really the stage of cycle of private equity into public markets. And that's why it's a very important concept in terms
venture capital. We do have seed financing. Yes, scaling of a prototype to, yes, a product. Help us break that down.
Yes,
Investors
so
put in money.
Whilst we
yes.
are developing an idea, a seed financing is really the seed. When we think of a seed, we think of that initial input. It's not a chicken and egg situation, it's a seed capital situation where there's really nothing, and we hope that that seed can germinate.
Yeah.
And so that venture or idea stage, what we're calling the idea stage, so many people refer to it as seed capital because it's the initial proof of belief from external providers of capital that we can germinate from this process and lead to growth as a result of this. So that's usually capital that is used to finance really the idea, get the idea into a commercial stage, or get it into a business concept stage, or what we are calling the business model stage, or how into growth, into consolidation, and hopefully into listing. So that really shows you that capital in itself evolves over time, and different enterprises require different forms of capital in terms of its application. And seed, while being very risky, takes a very long-term view, whereas the growth stage might be not as risky as the seed, but certainly will take a more longer-term view than the public market might be willing to accept in terms of risk-reward relationship.
Let's talk about the other private equity funding types. We do have the real estate private equity. By 2023, it's going to grow by over 50%. 1.2 trillion US dollars is going to be in the real estate. Break that down for us. Real estate.
So in terms of private equity structures, real estate also offers another alternative private capital funding vehicle where real estate can be organized under real estate investment trusts. And these trusts can either be as partnerships, which are not publicly traded and traded in the private realm, or brought to the public market for the rest of the public to benefit once the major risks or the underlying risks of the real estate have been addressed. So that is just an asset class under real estate, because real estate can be hived off sufficiently. The commercial opportunity for real estate necessitates or presents an opportunity that can be taken on its own, defined as a private equity opportunity that can be sold as a different asset class under either trust or private partnership in the capital languages used. So really what we are saying here ultimately is that the different forms of capital largely define the underlying asset. In the case of real estate, in the case of private equity or private debt, defining the use of capital or the source of capital from a private market. But all that lingo certainly comes down to one thing, getting money from sources of capital that are willing to partner alongside the underlying business asset, whether it is a commercial business, selling a product or service, or a real estate venture, underlying that capital from a private source, which is then managed in a private environment and given its structures, before it can be presented to investors beyond the private market, which is in the public market usually, for them to benefit.
Let's talk about the most popular private equity funding, and that is leveraged buyouts. This involves buying of a company completely to work on its or improve its financial health and then sell it to another contender who wants to buy it or conduct an initial public offering. Please break down that leveraged buyouts, private equity funding.
And we've not seen this in Uganda in terms of practical context, but maybe to a certain degree. But largely private equity investors in developed markets and Western markets looked for ways to exit their equity positions. And that, through one of the ways that they sought was to go into the debt market and raise debt funding. And that debt funding was used to change the capital structure, recapitalize or restructure the capital of the company by paying off the equity providers and replacing that capital with debt. So that's what you call a leverage buyout, where you buy out using debt. That kind of aggressive way of capitalizing companies is more for mature enterprises that are more likely have gone beyond the proof of idea, proof of concept, and have a clear market niche, have a clear product, have teams in place, and have structures in place to enable the management of that capital, such that when they are presented to the debt markets that are a bit more strict and a bit more accountable and high risk and highly regulated, they certainly pass the test. In most cases, why companies remain private is because they do not pass what we call the public test of investment. And that's not to say they are not good companies, but it's because the demands on compliance and regulation in the public market certainly are daunting to the extent that these companies do not meet that threshold. So different forms of capital come in because of different levels of risk and the stage where the business is. And they are given these names to kind of identify or differentiate them from the different opportunities that they are, and also to communicate better to investors where exactly they are playing and what risk they are taking on, and what's the expected reward.
David Ivan, yes,
lingo,
David Ivan Wangolo, let me take you back to the 2008 financial crisis. Here's a class of private equity funding that so many companies were clamoring for. Distressed off vulture financing, when you invest money in a struggling company so that it can get back on its own feet. Break it down for us. How many companies in Uganda, or are they even clamoring for this class of asset financing, which is private equity funding under distress funding?
So a lot of the distressed funding, in my opinion, for the Uganda market will be originated by the banking circles, where the non-performing assets certainly will arise from. And especially in this COVID environment and pre-COVID environment, when we're having serious challenges with many companies, some of these assets were taken off balance sheet from the banking balance sheets and hived off into special purpose vehicles. And those special purpose vehicles then go to the markets and raise money. And that money is called distressed asset investment, because the assets underlying the special purpose vehicle are essentially distressed. Now, the purpose of hiving off those companies from a regularly performing asset is to be able to work on them in a distressed environment, raising capital that can meet that risk and reward scenario. And that's why we call it distressed, and try to give those companies a chance to turn around their fortunes. So that really then breaks it down. So as I said, the private equity definition largely is to address the underlying asset, and what is that asset addressing. So if it's a distressed asset, you're likely to go out to the market with a distressed private equity. All
right, David Wangolo, in the interest of time, break down for us the last class, which is fund of funds. Break it down for us. The one where investors choose to, fund hedge funds or mutual funds. Then we can go back to Susan and Mr. Allen.
On a funds on funds basis, maybe let me give the context of Uganda, such as, say, Pearl Capital Partners is a direct investment fund manager and raises money from institutional investors who then invest in a fund and give the funds to Pearl Capital Partners to manage on their behalf. In a funds on funds scenario, we then have, say, a development bank such as the Uganda Development Bank creating a super fund, and why UDB can do that is because of the clout they have, the political will they have, and the ambition they have. So they raise what we call a super fund and then identify sub-managers below that fund, say investing in different subsectors. So that would be a typical fund of fund structure, where the fund of fund is managed, say, at the Uganda Development Bank level, and then the fund level is the different sector or sector managers deploying that capital from the UDB level to the economy. So that's how you would think of a fund.
Capital partners. Susan Kaiser is a board member with CFA Society of East Africa. She's also the founder of Kayan Consultancy. Susan, let's talk about another issue. The fact that Ugandans are not clamoring for private equity, the opportunities within the private equity sector. They're not clamoring for the listings at the Uganda Securities Exchange. They're not clamoring for the corporate bonds, the medium-term notes. Why? I would like to know.
The first thing, I think the first most obvious thing is awareness. The business owners are not aware, first, of these options that are available. That's why the CFA Society East Africa has teamed up with the Capital Markets Authority to create this awareness. First, let us create awareness. There is this option of more patient finance. That things are usually done in Uganda. Business owners usually have, or getting a loan from the bank. That is a reality. So when you're attracting others and transparent, farm has a tax liability going back several years, so they're not able to take up that option because of the tax liability, because they've not been doing their taxes correctly. So one thing is, you have to have your books in order. You have to be doing the right thing. And the business owner should not look at it as a bad thing. Yes, you'll pay more in taxes, but you're also receiving more capital, which allows you to create more goods and services, which increases your revenues, which increases the money back to you. And another thing is an unfounded fear, within the business owners, that they will lose control of their business. Like if I bring in a private equity fund or debt fund money, it's like I will lose the say, because business owners, it's my business, we're doing this as a family. If I come in today and say I want this person out, they'll get out. If I come in today, they want to scrutinize every tiny expense, right down to the expense of whether the staff are buying tea leaves for that tea or if you should give them just hot water. The business owners are getting involved so much in the day-to-day operations. So they're not seeing that this is not giving them time to step back and look at the vision and the strategy and allow their business to grow. So they want control. So they feel that by bringing on other investors, they will lose this absolute control of their company, and someone will have the right to tell them what to do. So what I markets, let's look at something at Google, for instance. This students and what is the potential for growth, they don't know, there's not enough information. So they also need information such that they're able to see companies which are viable and make investment decisions.
All right, because you and I know very well a company that is struggling, but we haven't seen any of these companies actually go to clamor for private equity funding asset classes like voucher financing, funds for funds, or even venture capital and so forth. So information dissemination is a big pointer here.
Yes.
Now, let me also bring in Alan Lwetabe. He is the head of reserves management at the central bank. We are talking about Bank of Uganda. Now, Alan Lwetabe, let's focus on the macroeconomic outlook for this country, Uganda. What are some of the factors that could actually ensure the growth of the private equity investment sector right here in Uganda?
Romeo, I know when I say this, a lot of people will say I'm being too optimistic and I'm speaking as government. But in this capacity, I'm still speaking as an investment professional, and I would like to share what I see from where I sit. That over the next 12 to 16 months, we are going to see a difference in performance of the overall economy. Already we have seen some moves. The central bank has taken some steps. We received information last week that the central bank reduced its central bank rate from 7 to 6.5%. That is very significant information, because they are telling us that interest rates are expected to be lower. And so if interest rates are going to be lower on government securities, on loans, expectations, what we see is that the traditional investments of pension schemes.
I'm afraid, Alan, we can't hear you very, very well, so I'll just have to have that as it is being rectified. Let me first go to David Ivan Wangolo as the issue of sound is being rectified. David Ivan Wangolo, when we talk about investors within the private equity funding, we're talking about institutional investors and also accredited investors. But largely, how do they make their money? How do they ensure returns? People who invest in private equity.
Will be largely an investment to create value. When we go into private partnerships with enterprise or business opportunities, it's largely to create value in those enterprises and then find other takers of that value, depending on the risk-reward relationship, as I said, they would like to assume. So the people who probably start businesses are not likely the one who run mature companies, and for different reasons. Those who like to, serial entrepreneurs would like to start a business every day, and they certainly have the kind of private equity partners who partner with them. And those who run mature businesses have different sets of investors. The point here is, the point of convergence is creating value in businesses such that they can be sold. Now, what is creating value? Creating value in businesses is finding niche markets that can grow, and continuously defining those markets that are differentiated from your competition to be able to grow. It's continuing to have clear business models with clear business margins that can enable the business to be profitable. It is also finding management risk, and so private equity is largely also such that then it can be presented to external stakeholders. So that is the
getting information.
The tunnel of value creation
yes.
to sell the investment.
We're also getting information that these investors are asking for exorbitant management fees. That is over 10% per annum. And we're talking about when they sell a company, they actually demand over 20%. So it is 10% management fees per annually, and then there is 20% that they take home after selling the company. High management fees.
I mean, the convergence there in terms of the payoff versus the, when you look at the percentages, they might look exorbitant, but value creation is a place of, if you can indeed create that value, and that value means something to the stakeholders in the market, then you can demand for that fee. Sorry, I didn't get part of the question. I think I missed a certain part of the question.
High management fees on the part of the investors. The fact that they are charging over 10% for management of these firms annually, and then the 20% that they demand when they sell a particular company that is grappling.
No, usually the structure of private equity is a 1.5-10 10 structure. By that I mean 1.5 on the funds under management, or 0.5% or 2% on the highest end on the funds under management, and then on a fee which, if you achieve the returns over and above the investor expectations, then the private equity manager can earn even 20% of those returns. So the return is incentivized on performance, not anything other than performance. If there's no performance, private equity as an asset class certainly does not attract any capital. So really the management day-to-day running fee is a very, very small percentage globally of the total fee. The incentive return is the 20% is performance driven.
All right, David, thank you very much for ironing that out. Let me also bring back Alan Wetabe, the head of reserves management at the Central Bank of Uganda. The issue has been rectified, sir. So in terms of the macroeconomic outlook, what factors are there and what factors are likely to influence the private equity investment industry within Uganda that will also clamor for the growth of other alternative sources of financing? We are talking about the listings at the Uganda Securities Exchange, the corporate bonds, the medium-term notes, and so forth. Factors.
Okay, thank you very much. As I was saying before, that one of the key things that drives investors is return. And we are seeing already movements from the central bank indicating that returns on traditional assets are going to be lower. The central bank rate was reduced from 7 to 6.5%.
That's great.
And that's already an indicator that returns on treasury bills and bonds are likely to be lower in the next couple of months.
Wow.
What does that mean for an investor? So a lot of investors hold over 90% before tax. And the tax expect that a lot of investors are going to be thinking about what alternatives are available for them. And we've discussed about pension schemes.
Indeed.
Who are some of the private markets to become the darling of investors. And so what that means is that we might see a lot of pension schemes, investment clubs, high net worth individuals taking more interest into investing in private equity and private debt. And so what we're trying to do with the CMA and CFA Society East Africa is how do we support businesses to be ready to receive interest from investors? Because that's going to be key. It's like a marriage, it's a dance. And so you must be ready, you must have your dance clothes on when the partner arrives. So it doesn't work any other way. So the best way for us to prepare looking forward is to have businesses aware that this is going to happen, but they must prepare, have their books of accounts in order, have their corporate governance, have their business models clear, such that over the next 6 to 12 months, we will start having conversations about the potential for private investors to invest into private companies. And so the factors are converging very well to create a spotlight
Indeed.
that's going to be shined on private equity.
The future is positive.
On private equity as an asset class.
That's Alan Wetabe, the head of reserves management at the Central Bank of Uganda. This conversation is largely centered around how best we can rebuild financial resilience in a post-COVID-19 environment. Last week on Friday, we were talking about a capital markets perspective. Today, we are largely focusing on the ideas for the firms and innovators in that regard. Let me also bring in Susan Kaiser to talk about a description of what particular firm can be investment ready. Could you please describe for us how you can be in a better position as a company to be investment ready?
I think the first thing is, which I have mentioned earlier, is have a proper set of books of accounts, have your ledger accounts all in place, such that someone is able to trace your cash flow. How much cash have you been? Such that they're able to forecast in the future what the potential returns that you have. I think this is very important because it will be your books, an analysis of your books, the market that will enable the investor to make a decision. So if you don't have your books in place, then there is really there's no point of even beginning. And then even with that, they have to look at the industry that you're in. Look at really, as a business, what is your strategy? Because you may just be like maybe buying or selling, but you have no plan for the next 5 years. So the investor is going to work with you as a business owner to grow. They're going to give you training and advice, but you need to have a plan of the future. What is your future plan, for growth? And then an assessment of the industry that you're in as well. I mean, is this industry worthwhile? Because you could be in an industry, for example, which is constrained, in terms of returns. But what are you doing, as a business owner to mitigate these challenges? So I think the biggest thing for the companies is the set of books of accounts. Yes, I think that is the biggest challenge. Have a governance structure in place in your own small way as a business, in a way of how your business is governed. Don't let it be you as an individual, you're signing off expenditure, you're doing this, you're receiving supplies, you're the one doing everything. Such that if you as a business owner were to, let's say, pass away, there is nothing, your business has nothing, to offer.
All right. We are largely coming up with ideas for the firms and innovators in the way of a conversation where we are largely trying to devise means on how best we can rebuild financial resilience in a post-COVID-19 environment. Remember, last Friday we were talking about the capital markets perspective. Now we are talking about ideas for the firms and innovators. We've largely talked about firms. What about innovators? What about individuals? Are they largely also welcomed in this private equity story?
I think for the innovators, they mostly attract maybe the angel investors, the seed capital investors who are interested in ideas. So they're looking at, these are the investors who are looking at, they're taking a high risk. They're putting part of their money aside, taking a high risk with the knowledge that, there's a high chance that they won't get returns. But if this innovation succeeds, then the payoff is large. So they'll put in a number of ventures, knowing that the ones that will pay off for the others that won't. So this investor, you're looking for an investor who's willing to take that risk, who has the capacity to put some money aside in your venture with the risk that it may not work. Because when we look at innovation, and innovation may be good but not accepted by the public, and innovation may just not work for this market. So you're trying out new things and failing and trying again. So what you're looking at those investors, the angel investors, the seed capital investors who are willing to take that risk. Yes.
How does a potential investor go about in determining that this particular business offers an investable opportunity?
You look at a number of things. You look at, you have to look at maybe that you can value. Look at the cash flow, you can project the future cash flows that you're expecting. You have to look at the industry as a whole, the industry they're in, how they're able to compete. You look at maybe the country as a whole, the culture, the culture of the company, the economy of the country as well. So there are different valuations that you can do. You can also do a comparison of similar companies. If you have a company that's not listed, but you have a company that is listed, that is similar. That is in a way similar. You can look at that similar company and compare it with this company that you're looking at. So you can also do a comparison in a way of valuing the company. So there are different ways as to which different investors reach about their valuations, depending on their plan, as in what their investment goal is. Are they there for 10 years, 5 years, then they want to exit? Are they there for 5 years? So different investors will come up with different opinions about the same company.
Susan Kaiser, thank you very much. And we are running out of time, but let me give this last question to David Ivan Wangolo. The challenges that are hampering the growth of the private equity industry in Uganda here as an asset class. What are some of those challenges hampering its growth? And what could be the immediate frameworks that could go a long way in addressing those challenges?
Thanks, Romeo. There are three basic challenges that are hampering private equity growth in Uganda. The first is on the policy level, or what we call the regulatory level. How are we registering private equity vehicles in Uganda, giving them the special status that they enjoy in other jurisdictions? You find that Uganda does not have a conducive policy yet to register private equity firms and attract private equity capital. And most vehicles are being registered outside Uganda in locations such as Mauritius. So that is one, how to make private equity firms register locally here, which is something the CMA is closely working with, together with the Yield Fund, PCP, Pearl Capital Partners, to ensure that happens. The second is attracting local capital. So if there's a conducive environment for registration, then local capital can come in. And one good thing about local capital is that it then makes capital from elsewhere a lot cheaper, or it de-risks foreign capital, and in that way makes access and cost of capital cheaper to the enterprises that are the target. And so local capital generation or collection is quite important from a policy point of view. In terms of policy, again, it's the taxes on private equity or private equity type vehicles. There's a double tax issue compliance there that I know the Capital Markets Authority is working with and consulting quite closely with Pearl Capital Partners to ensure that the environment improves and is harmonious with global standards. On a management level, which is the second level, we do not have sufficient skills to deploy private equity by the international global practice and standards. And that is skill either on the fund level governance side in terms of oversight, and also on the management teams that deploy and make this capital work.
All right. David Ivan Wangolo, he is an investment manager working with Pearl Capital Partners. Many thanks have been made the time to speak to us. He was not alone. We also did have Susan Kaiser. She is the founder of Kayan Consultancy and a member of the CFA Society of East Africa. And lastly, we did have Alan Lwetawe, the head of reserves management at the Central Bank of Uganda. Here's the final message from the Capital Markets Authority and the CFA Society of East Africa. They are calling on firms and innovators to actually clamor for alternative sources of raising capital so as to address issues of growth and early stage risks. My name is Romeo Busiku. I have another conversation coming shortly in the next 4 to 3 minutes. Keep it here.